Good morning. I'm Cheryl Hines, and on behalf of the Firewise Committee of Rossmoor, I'm very pleased to present our second presentation in our speaker series. Today we're going to hear an update on our master property insurance policy in Rossmoor. We're pleased to have with us today Ken Johnson, and some of his colleagues via phone are on from A.J. Gallagher. The firm was founded in 1927 and is a global broker with access to a number of insurance markets and solutions, which they have ably led Rossmoor through. The firm has been a valuable partner to Rossmoor community and has worked with us since 2010. And they've helped us to find some very cost-effective and innovative solutions in a very challenging market. Rossmoor's success with its insurance program is a prime example of the value of teamwork. And that's when our community volunteers, the Rossmoor, Walnut Creek, both management and board, and our mutuals work together for the common good. We're asking that you hold your questions to the end of the presentation, and some of our other members will be circulating with the microphones to take your questions. This is also going to be recorded, and it will be on the Firewise website for future viewing and also televised. So now I'm going to turn it over to Ken and his colleagues, Zach and Miles, for an interesting discussion. Thank you.
Thank you, Cheryl. It is always a privilege for Gallagher to speak to Rossmoor. So thank you very much for your time. Rossmoor is a very important account to Gallagher. It's a long-standing account, as Cheryl mentioned, since 2010. Some of the people, as she mentioned, Gallagher is a global, we're the number 3 insurance broker in the world. We do business in 130 countries around the world. We have a little over 77,000 employees. My employee number at Gallagher is 8864 or something, so I've been around the firm for quite a period of time. On any given day, there's probably around, I'd say, 40 people or more around the globe that are working on Rossmoor in one capacity or another. They could be evaluating contracts, looking at claims data, doing modeling or insurance placement. These folks are just a few that are key to that group. Two of these gentlemen, Zach Phillips and Miles Lintott, are on this call remotely. You'll see on this screen the gentleman to my right, Michael Gallagher. At Gallagher, our CEO and chairman of the board is Pat Gallagher, and his brother is Tom Gallagher. He's the president of the company, and Michael happens to be Tom's son. And so why does that matter? That matters because we have a big presence at Gallagher. Tom Gallagher lives in Chicago. He also lives in Marin County, and so he's very cognizant of wildfire. He and I will have conversations about the Rossmoor account. And so the nice thing is, if we need resources from Gallagher, Rossmoor gets them, the best of the best around the globe. So you'll also see Sandra Moreno. She's been my partner since I took over the account. Prior to me, it was a gentleman by the name of John Tastra. So there's only been two broker people like me on this account over the period of time that we've been on it. Tony Farias is a gentleman he's very close to your Rossmoor group. He also works very closely with Rossmoor Property Management, and that's one of the reasons you have an excellent workers' compensation history or experience. Compared to your peers, you are at the best of the best in the state of California in terms of safety. In the bottom left, you'll see the domestic property. Those are for insurance companies that are on this property program. Charlotte Stone and Melissa Morales. Charlotte's worked on this account since the beginning, so she's the longest standing member and understands a lot about Rossmoor's property exposures. And also on the line today is Miles Lintott, who is with Gallagher London. So that was the Gallagher team. The team here, when the property market, when property market became very, very difficult. Insurance companies were demanding higher deductible. We had one of our key partners was Beasley Insurance Company, a London syndicate. They said, hey, no more $250,000 deductible. We want $1 million deductible. Coverage was just very difficult to get coverage over the last, say, 5 years ago this started. Capacity was shrinking everywhere. Rossmoor had never had an insurance appraisal. So the valuations were kind of worthless when global underwriters looked at it. Claims, we would have a good year, then we'd have a $1 million fire. Then we'd have a good year, then we'd have a $2 million. Rossmoor would have a $2 million fire. So it wasn't, there were a lot of challenges. And so they brought together the insurance task force. And that was led by a woman by the name of Herma Lichtenstein. And she took it on. And the first thing that she did was she hired people outside of the normal Rossmoor group. They worked with reinsurance guys and insurance brokers, and it was kind of like an informal RFP to determine whether Gallagher was getting the job done. After about 6 weeks, that group came back and said, yeah, Gallagher's getting the job done. They're doing everything they possibly can, plus more. They're coming up with creative solutions. And so at that point, Herma just said, let's go. We're ready to go. And so these folks that you have on this insurance task force are remarkable. Virginia Lawson, she's a woman that ran risk management for large global corporations. She's very familiar with captive insurance structures. Michelle Colucci, historically throughout my career, Michelle is a insurance underwriter in Northern California, and throughout my career, I would strive to get accounts that I had in front of Michelle because she was smart, she was creative, and she could find ways to make insurance programs run for clients. You've got David Kadama on this group. David Kadama is with the California Surplus Lines Association. He's one of the most highly respected individuals in the state of California for insurance. You've got Cheryl Hines, Goldman Sachs. I mean, you've got people, Jeff Chung, a banker, people with great business backgrounds. And together, working with Gallagher, we've built a really successful program for Rossmoor. But we didn't have a framework to make it, to kind of prove it to the insurance world. So what we did was Rossmoor created the Firewise Committee. And as of October 28th, the National Fire Protection, NFPA, now recognizes Rossmoor as a full Firewise community. It gives them the ability to look at Rossmoor and have validation of, oh yeah, they maintain this $3.1 million shaded fire break. They have 2,000 volunteer hours. Those are just a couple of examples. But this group, the work that the Firewise community did is remarkable. To be able to take such a huge entity like Rossmoor and move it into a Firewise capacity. So congratulations to all of those folks. And so where's that leave us? That leaves us with the fact that wildfire risks are real, but Rossmoor is winning. And so I'm going to just kind of talk a little bit about your insurance program, your property insurance program, and why it's vital to have have Firewise run alongside it. Global catastrophes, they're rampant, right? So far in the first quarter of 2026, we've had about $58 billion worth of losses around the globe. Cat losses are happening with greater frequency. And insurance companies are paying those losses, but there's a lot of entities around the globe that just simply can't get insurance. And so was one of the challenges that we were facing. And so you got to keep in mind that it's just not the insurance costs that are going up. 80 to 90% of the insurance costs are not from actual losses. They're from the increased cost of construction, labor shortages, the electrical, plumbing, HVAC people, higher property values. Property value inflation just keeps going up, and more concentrated development. So even if the wildfire risk over the last 8-10 years had not increased at the rate it had, there's still, insurance would be much more expensive than it would have been 10 years ago because of all these costs. But so let's jump then into the reality of Rossmoor. So Rossmoor sits right in the middle of this. We are 100% in a wildfire zone. the risk of is presented as $2.77 billion in total insured values, a highly concentrated community with mostly wood frame structures without fire suppression, without fire sprinklers. From an insurance standpoint, that combination puts Rossmoor in one of the hardest categories to insure anywhere in the world. And so here's the good news, and this is where my partner, Miles Lintott, will be able to chime in. Rossmoor is viewed globally by property underwriters as one of the best run risk management operations anywhere. That's a big statement. And that's coming directly from feedback that we get from Lloyd's of London, Bermuda insurance companies, Asian insurance companies, that would be Tokio Marine, Sampo, Mitsui, those types of firms, giant insurance companies, and all the US domestic carriers. So Miles, I hope you're on this call. We recently were in Philadelphia together at an event called RIMS, Risk and Insurance Management Society. Jeff Matheson was there, and we had, so maybe you could kind of add some color to what I'm talking about?
Yeah, absolutely. First and foremost, thank you for letting me join this call. I know I've had the pleasure of meeting some of you before, but it's always great to be able to have the chance to introduce myself and talk about what we do for you and Gallagher London as a whole. So by way of introduction, my name's Miles Lintott. I'm the Executive Director, Gallagher Specialty here in London. I've been at the company for 14 years. 12 of those years I've had the pleasure of working on your account, where I've headed up the team involved in placing the London, Bermudan and European portion of the programme. We've seen that capacity that the London market has offered grow since 2004 when I first started working on the, it's 14 when I first started working on the account. Part of that is the appetite of the London market. The second part of that is the work that Rossmoor has done to be able to gather the interest of the London, European and Bermudan insurance marketplace. So traditionally, when we first started working on this account, you had quite a low retention, which meant that losses started to creep into the programme. You've made the change in the last 4 years with the ART product that you've made. What type of impact does that have? That basically puts you at the top of the pile when it comes to trying to find capacity and get the interest of the insurance marketplace, both domestic US and London. Why is that? They like to see you taking the skin. They like to see clients taking skin in the game, and by you taking the size of the retention you've got, means that they know that you're taking risk management seriously. Wildfire as a whole, as Ken's alluded to a minute ago, really has only sort of kind of popped up in London in the last sort of 6 to 7 years. A lot of that is following the events that we've seen in the media over here in the UK and the size of the wildfires that have been occurring and the frequency. So when traditionally they've had markets who've written this account, all of a sudden that's now been heightened for them, and they want to know more. They want to know what you're doing from a risk management perspective. So the meetings that we've had over the years at RIMS with Jeff and Ken in the London marketplace, the visits that we've been able to bring Bermudan and London markets to Rossmoor Park to actually go around and do a site visit, talk to the fire chief, understand what you're doing, has meant that the markets have got incredibly comfortable with A, the risk, but B, also you as a client. And that is single-handedly one of the most important things when we're talking about large wildfire exposed accounts. The questions that crop up are, what is the client doing in order to mitigate against these losses? The fire breaks, the investments that you've been making to both your buildings and the surrounding areas to protect yourselves from wildfires has been top class. Probably the largest information that some of the markets have got on any account, certainly that I work on. I work on a large amount of real estate, hospitality, large amount of senior living, and the majority of it is based in California. And I would say that Rossmoor Park has been at the forefront of what you've been able to achieve, whether that's getting goats in to clear the surrounding vegetation, that whether that is creating the fire breaks, and then obviously Firewise comes in as well with that accreditation to be able to give them the comfortability. So now in 2026, when we have the meetings with the markets, it's to catch up with Jeff and the team to hear about what else you're doing, not if you're going to do anything. Which has meant over the years you've seen an increase of capacity from the London, European and Bermuda marketplace. I'll use one market as an example because there are so many here in London. Chubb Bermuda, we reached a stage where they were offering about $600 million worth of capacity, part of your limit. And we reached a stage where they basically turned around to us and said, look, the wildfire risk is too large. We can't write this account anymore. If we carry on writing this account, we're going to have to offer substantially reduced capacity. That's where Ken came up with the idea of bringing the market to the site to have a look around, to actually truly understand. And we had various meetings. Following that, and I think that was probably about 4 to 5 years ago now, they actually ended up offering increased capacity. Fast forward to 2026, we've just renewed the account. They have just increased their capacity as a business from 650 million to 850 million. And I'm really pleased to say that Rossmoor Park is the first account that Chubb Bermuda have written this year where they've offered the full $850 million of capacity. And that is an illustration of what this account have done over the years to protect yourselves from the risks that are out there, especially from the wildfire. And it's something to be really proud of, in the fact that where you can go from a market not willing to write capacity to all of a sudden offering increased capacity, but one market offering 850 million is completely unheard of. So I think that was a real success, and they offered that on a multi-year basis as well, which basically means that you know that you've got that chunk of capacity for the next 2 to 3 years. They don't do that very often, but they do this on this account. So thank you for making my job that slight bit easier. We really appreciate it, and it's great to work with clients who take risk management so seriously.
Thanks, Miles. That was an excellent analysis of exactly how the marketplace views Rossmoor. While you're on the call, the other part of it, that Chubb is on the top of the program, and on the bottom you also have a relationship with. So Chubb being number 5th market cap company in the world, you also have a relationship with Allianz, number 2 market cap company in the world, where they said. And this is a little technical, so kind of bear with me. You have an alternative risk transfer program. That means that they were taking the primary $5 million of your insurance program. And they said, we're very comfortable with you. You guys are a great account. We would like to increase that from $5 million to $7.5 million, reduce your premium by $1.15 million, and give you a lock-in, extend the 5-year period of this policy out for 5 more years. So that means that the rate for the most hazardous part of the program, the primary $7.5 million, is locked in for 5 years, regardless of wildfire, regardless of hurricanes, convex storms, or cyclones around the world. That's a big advantage. And on that program, it's experience rated. So 15%, the insurance company, Allianz, keeps 15% of the premium. The balance, the other 85%, is up for return to Rossmoor, depending upon losses. Currently, over the first 3 years that you've had this coverage in place, you've banked, or you have in your account earning interest well over $10 million. So it's just another example of a fantastic experience and a well-run organization. Any comment on that, Miles, or that was pretty much it on Allianz?
I think just to add one bit to that, Ken, I think it's very important to say is that the ART product has really had a big impact on what the London market above that product can offer you from a rate perspective. Had you had not taken that, you would have had a much lower deductible. You probably would have had some losses that crept into this current program. The ART product is one cost, but the program above that is another cost. And the program that we're currently offering since implementing that ART product has enabled us to be able to claw back a substantial amount of rate over that period to improve the cost of insurance that you purchase up to, and giving you the ability to buy additional limits. And I think it's given the London market, European market, and the domestic market a comfortability that they know that they can write this account for a long-term period at the reduced rate they're currently offering, given the retention you're currently taking. So it was a fantastic idea from Ken and the team in San Francisco, and it just makes your account a lot more palatable for the market, given the exposures at hand. So thanks, Ken. Appreciate the chance to speak.
Yeah, well, thank you, Miles. I know it's late in the day in London, so thank you very much for joining us today. So, market reality, and this is where Zach Phillips will come in. Here's the actual cost reductions that we've experienced. Zach, can you see this screen? Do you want to talk about this a little bit? Okay.
Sorry, no, I'm here. Sorry, I'm here, Ken. I forgot to unmute.
All right. Can you see my screen?
Yeah, it's pretty small because I had to do this on my phone, but I pretty much know the numbers. I might have to turn around and look at my computer. But anyway, we've reduced the cost a lot on this program. The rates have come down significantly. As it says there, 14% rate reduction as of June 1st. We had as of January 1, when we had that period where we're shifting our renewal, we dropped around 12%. So in total, the rate for June 1st to 2026 is 25.5% lower than the rate as of January 1st, 2025. So that's massive savings. Part of that is coming from that ART program, which we were able to increase the limit and reduce the premium on that. And the rest of it comes from the tower, which, even though we've increased the limits we're purchasing, the premiums have come down. For example, you paid for 17 months of premium. You paid basically the same amount as you did in 2025 for just 12 months of premium.
Yeah, that's what allowed us to take advantage of the of moving the expiration date. So, this all kind of comes together because you've got relationships with insurance companies who trust you as a client, and so. If you just you're a regular client and a big client, and you go to the insurance companies and you say, hey, I want to change my effective date from January 1st to June 1st. Well, a lot of them, they don't have to say yes to that, right? And so, but everybody on the program did. Remember, this is a big layered up property program where we've got 50 insurance companies. So they all had to agree to extend their coverage and give us a rate reduction and then another rate reduction. So we did that, so we moved to June 1st. Why would you move expiration dates? Because today is June 11th, and there's a fire alert out there. We're going into hurricane season, we're going into wildfire season, and we're in front of it. You just bound your coverage on 6/1. We don't have to worry about being at the tail end of that and having a January 1 renewal, which also happens to be the date where most reinsurance contracts get renewed, on January 1. So it holds up insurance underwriters from being able to issue their quotes. So it's December 10th. It's like, well, where are the quotes? What's the problem? Well, Swiss Re or Munich or Travelers, they haven't gotten their reinsurance agreements in place, so they can't release their quotes. So January 1 was a terrible date. June 1, because of the insurance task force and their dedication to pushing this, it's a little. Some people may say there's other dates, but I believe June 1st is the ideal date for a client that has any type of cat exposure because it puts you in front. And now we don't have to worry about the results of wildfires or hurricanes until June of 2027. And also these insurance carriers are offering long-term agreements. they're saying, hey, Rossmoor, listen, we believe the market is as low as it's going to go. If you would like, we'll give you a 5% reduction in your 2027 renewal as well. So we're just finalizing some of those, working with Jeff Matheson and the insurance task force team. So that leads us to why is Firewise so important to us? Because you're doing all these things, but there's no way for underwriters to necessarily find a third-party validation of them, right? So it takes, as one of the task force underwriters said, she said, look, if I have two accounts that are sitting on my desk and one of them is a Firewise community and one of them is not, which one do you think I'm going to pick up? I'm going to pick up the Firewise community because they have a plan. I can see if they're executing and the inspections, the clearing, the hardening, and is it documented? So underwriters always have auditors looking at their files. They say, well, you gave this thing a 37% rate reduction or scheduled rate. Why did you do that? Because they're Firewise. Here's all the information. It's the perfect model. Is what Rossmoor created. So yeah, underwriters look for those credits. Like, do they have defensible space compliance rates? Are inspections being done? Is there centralized vegetation management? All of those things Rossmoor has, and because of Firewise, it can be defined. Again, same type of thing here. What do underwriters look for? They look at severity and frequency causes, ignition probability, structure to structure spread, fire suppression success probability, right? And so Firewise gives you that blueprint. It gives you brush clearance, tree management, everything Rossmoor is doing. And so what is the impact the underwriters see? You guys are saying brush clearance. They're saying reduction in ignition and spread, reduced in laddering fuels. You've heard Jeroen talk about that all the time. If you go to his meetings, laddering the trees that are being replaced with the old trees. So it's just it's a good match. Firewise, again, it's never a guarantee, but it is a performance advantage. It does not eliminate wildfire risk. It does not prevent cat losses, and it does not materially change the underwriting outcomes, but it does improve the insurability of your community, which is what many of your peers do not have, and I see it. Miles was just talking about it. It does differentiate Rossmoor from other peer communities because I don't think there's any other community this big that has achieved Firewise certification. Finally, I'm getting to the end of this of why Rossmoor outperformed the market, because it demonstrates risk control. It's consistent in its execution. Its scale and centralized management through Rossmoor Property Management. Proven track record with carriers, right? Because you guys partnered with them. They said, hey, we don't want to trade dollars with you. You're having $1 million loss, a $2 million loss. You need a higher retention. So Rossmoor implemented the alternative risk transfer and took it to $7.5 million. That's partnering. Those are the comments that we hear. That's item number 5, willingness to partner in the ART retention. But here's the key. This is where everybody at Rossmoor is involved. What's the insurance market, I should have said, will expect next. A continued Firewise validation. Increased community hardening over time. They want it. Every year they're going to want to see that data, documentation, and reporting. Managing the infrastructure, which you guys are doing. The old Zinsco panels are slowly not slowly, but they're being replaced throughout the valley. Vents are being replaced, windows are being replaced, roofing. You're a forward-thinking community. And as a result, the community adapts to wildfire behavior. Gallagher as well is adapting. So we have these loss control engineers and some of the best in the world. There's one woman by the name of Deborah Freeland, who I didn't include in this list on that map of people that are associated with the account yet, because she's just starting to engage. Deborah Freeland is a woman highly respected in the fire prevention world. She just assisted in the sprinklering of the spires of the cathedral at Notre Dame in Paris, and she is going to be dedicated to Rossmoor in terms of big picture stuff. alternative water supplies, different things like that. And she's going to bring a lot to the team. So that's exciting stuff. So Gallagher continues to grow with Rossmoor. Finally, in today's property insurance market, the difference between communities isn't location, it's performance. And Rossmoor, Walnut Creek's Firewise efforts in confirming performance at a level that few communities anywhere in the world have been able to achieve. So congratulations. It's a very impressive amount of work that you've done. And so from Gallagher, I'd just like to say thank you very much for the time. You taking over?
So we're now going to open it up for questions, and we've got some people that are going to circulate with microphones. So if you have a question, raise your hand and we'll be right to you. Thank you.
Hi. Can you explain what the advantage of the ART account is, the $10 million account? I don't understand what that is. Please?
What is the advantage of the alternative risk transfer? A couple different things. One, you're a big account, and big accounts, insurance companies expect big accounts to have larger self-insured retentions because they're not in the business of trading dollars. If you're going to have $1 million fire, because you're big, and even though these are big numbers, they still view them as nuisance losses, right? I'm trading dollars with you. You have $1 million fire, and then you have a good year, and then you have a $2 million fire. You're big enough where you should be able to absorb that type of exposure. And that's the concept from underwriters that underwrite big accounts, right? In reality, Rossmoor is 23 separate HOAs, and we just don't have a common balance sheet. We're not Levi Strauss. We're not Google, right? Everybody is on their own, and so for Rossmoor to absorb that kind of a $10 million, $7.5 million retention, that's difficult, right? So is there a happy medium? Is there somebody out there that could fulfill that need and make it even better and advantageous to us? Well, yeah, that's what Allianz offered. They said, okay, I'll give you a buffer. I'll give you a $7.5 million, originally it was $5 million. I'll give you a $7.5 million retention or alternative risk transfer program, which to the insurance underwriters like Beasley and Zurich and AIG, that looks to them like a deductible, right? They're going, oh, nobody's going to touch my coverage until they burn through $7.5 million. So it's kind of working both ways, right? It's satisfying the fact that you're telling the marketplace we've got a $7.5 million deductible, even though you've got an insurance contract, but that insurance contract's doing two things for you. It's doing one, it's locking in a rate, protecting you from wildfire in aggregate, right? If the market's going to take off again like it did in 2018, your rate's locked in for 5 years. And if you're successful by eliminating those nuisance claims, you're only paying 15% of the premium. You're getting it up to 85% back into your credit account, which you'll be able to do different things with. So that's really kind of getting into the weeds of insurance, which some people like or don't like, but I hope I answered that.
From the owner's perspective, what does your policy cover in terms of the exterior walls, interior walls, everything that's inside the, what does your policy cover?
Yeah, that's a great question. Thank you for asking that question, because there's a lot of confusion about that. The insurance program that Rossmoor has is it's referred to as a walls-in program. Let's say my manor catches on fire. I leave a candle on and I burn up that unit. The insurance underwriter, the claims people are going to come in and they're going to rebuild that unit. They're going to rebuild the walls in, right? They're going to rebuild the flooring. They're going to include the walls, everything that's on the walls. They're going to include the appliances. They're going to include the countertops, everything in that unit that can't be you can't grab it and walk out the door with it. It's going to ensure everything except for the contents. So, and I've been in units where they've been on fire, and I've been in units, the same unit when the keys are being handed back to the manor owner. And basically what they'll say is okay, Cheryl, here for the carpeting, here's 7 different types of carpeting that you can pick, right? You know, why don't you take a look at these, see if you like one of them. If you don't like, or if you have something unique, let us know, right? So there's the carpeting. Here's the appliances. We got 3 different types of refrigerator, 4 different types of stoves, and you get to pick and choose, and they build it out. One of the unique things about this is we've got lots of different property insurance companies, right? So let's say it's a big fire, many manors are affected. Well, you don't want to have 3 adjusters coming out, one from Beasley or one from AIG and one from Zurich, right? So the way these programs are structured, you have one claims adjuster, and it's called Markel. Guy's name is Matt Takis, and Matt's been adjusting claims out here since 2010. He comes to RIMS and sits next to Jeff in these interviews with insurance companies, so he is known, so he hears what's going on, so that he can deliver best in class results to anybody that experiences a loss. So that's the confusion. People buy HO6 policies from Farmers, Allstate people, and they sell them a walls-in policy. We don't need that. You basically need an HO6 contents only. But in this hard market for personal lines, if that's all they're going to offer, what are you going to save? 30, 40 bucks? I'd just buy the policy that they have. But rest assured that you're not going to come into a unit that doesn't have walls or a refrigerator or an appliance or flooring, right? It's walls in coverage. No, it's a replacement cost. It's new.
The question was, is it replacement cost?
Meaning like you have an LG refrigerator or something, and are you going to be offered that same thing, or is it going to be something lesser, or will you have the same quality of countertop and that sort of thing?
Oh, no, you're going to get, there's not going to be, I've never seen anybody ever in any of the units that we replace that come on, we're not going to slice on dollars. I mean, this is Rossmoor. This is a huge, major account for the 3rd largest broker in the world. We're going to have a big problem with you if you're trying to nickel and dime one of our clients. That ain't going to happen. Because you've got claims people within Gallagher that are watching over McLaren's, right? You've got several different types. For every type of loss inside Gallagher, you've got a claims person that watches the insurance company's claims people. So if it's a liability claim, it's Helen Kong. If it's a cyber loss, it's Susan from New York. It's just, so we're not going to let any Rossmoor client be taken advantage of by an insurance carrier.
I'm glad that Gallagher is helping Rossmoor win the fire protection battle and keeping our rates as low as possible. My question is, do you feel in a reasonable amount of time that normal conventional loan mortgage companies will see the situation here and allow us to get normal rate mortgages?
Where's Jeff Chung?
How long are we going to be penalized here? Or is it forever? In your opinion, I know it's not.
Yeah. In my opinion, I think that Rossmoor has done what they need to do. I mean, we went out and we got an appraisal, and then we refined that appraisal over 3 years, and we're spot on to where we're supposed to be now, right? And then we go and we run modeling. We run AIR modeling, RMS modeling, and a third one, Signal, and then we buy insurance to 1 in 10,000 years the worst case scenario. That's as far out as modeling can go. We buy to the very worst case scenario, and that models to $1.37 million of loss, pretty much half of the value. But because of what Chubb did, we're putting up more. You're buying more insurance than you have, and we're buying $1.5 billion, right? So you're buying more insurance than the worst case modeling shows. You've done appraisals to say that's the value, right? And we checked. So we recently had a couple of small fires here, and we validated the cost to replace the units to get them back up and running against the appraisal, and it was spot on. It was right there. So
Why don't they open it up? Why don't they give regular mortgages here? What's the reason?
yeah, I saw them. They passed that one thing which had to do with about 6 months ago, where you don't have to insure your roofs at a replacement cost. That's probably got to do with the middle of America being hit with convective storms, hail storms. I just don't know the politics. Look, let's take a look at it from this perspective. You've got commercial property insurance. I'm delivering a 25, 26% rate reduction, right? At the same time, personal lines insurance, you can't even get it. It's just a political football, right? It doesn't really have, it's been made a political issue on the personal lines insurance. Because what's the difference, really? It's fire's a fire, right? I'm giving a 26% reduction over here. On this side, I'm terrified that I'm going to lose my homeowner's insurance, right? So I can't give you that answer. I gave you all that I could from an insurance perspective.
Ken, I was wondering if you'd give us a brief explanation of how the insurance premium is allocated to the various mutuals and who does it.
Great question, and I'm happy that I have my friend from Panama on the call with me. Is he still here?
I'm here, Ken, yes.
Okay, do you want to take that question, Zach Phillips?
Sure. We have been working with the Insurance Task Force to possibly modify the methodology, but the current methodology is we take the value of the buildings and then we apply what's called ISO rates, Insurance Standards Organization rates, that are based on years and years and tons of analytical data to say that a residential property has this type of loss rate, whereas a clubhouse has a different type of loss rate. So we differentiate between the manors and the clubhouses, et cetera. And then we apply a discount for the ones that have sprinklers. Okay, sprinklers are a major impact on losses. They significantly reduce how bad the loss is, how they stop the fire from spreading. So that the manors that have a discount, that have sprinklers, will get a discount because of that. And it's kind of a zero-sum game. So whatever discount goes to them, then is essentially a credit charge to everybody else. We're allocating the total bucket. Then we're saying, okay, discount for some of these. We got to spread those costs back. The next factor is loss history. All right, and so the mutuals that have had significant losses then get a surcharge for that. And then that surcharge creates a bucket that we can then spread discounts to the rest of the mutuals. So that's how the methodology works. That's been in place since 2023 or 2021, I think. Before that, it was a similar methodology, but it did not have the claims component. So, now what we're also talking about is adding in a risk management component, right? So your loss history says, okay, you've experienced bad losses. You essentially have caused more premium for the entire program. So that's why there's a surcharge for loss history. With risk management, the better you do, okay, we're all Firewise, but if you replaced your Zinsco panels, you don't have these things which can cause fires, the aluminum wiring, and you've switched to copper wiring, then potentially you can get kind of a discount because of that. The ones that haven't changed or are not in the process of changing wouldn't get it. Similar, the other components that we're working with the insurance task force to figure out how to apply could be, landscaping. Maybe you have the bare minimum of 5-foot landscaping, but others have the broader 20-foot, 100-foot landscaping. So those kind of issues. There's also vents in your roof that can help prevent embers from coming in. And there's also attic fire breaks that help prevent fires from spreading across. And those have been proven to reduce claims. We've had incidents where those could come in and reduce what a similar claim had been in prior years. So we have all those aspects. And that's what we're considering, how to update the allocation formula to reward good risk management practices.
But Zach, that's just, those last ones are just, they're just under discussion now. Basically, we just use sprinklers and losses.
Correct. Yeah. Correct.
Does that answer the question? Because that was a great question. Yes. Mrs. Colucci.
Wait, this guy fella back here has.
Oh, I'm sorry.
He's next.
Hello. Oh, okay. Okay. Thank you for your presentation. Yes. From your presentation, indicate Rossmoor did a good job for Firewise program. So my question may be previous this already asked. I just want to ask a simple question. All the insurance is for exterior, right? It's for the common area. So for homeowner, we still need to buy fire insurance for interior coverage as well as for umbrella insurance for those personal injury, those types of things. So we still need to buy those independent from what you present.
Again, very similar question.
Yes.
So if I move into Rossmoor and I buy a manor here, I'm standing in the manor that I bought, and there's refrigerators and stoves and flooring and countertops and walls, right? I know that all of those things, the walls, the flooring, the countertops, the oven, the refrigerator, the vents, that's all insured by Rossmoor. Rossmoor insures all of that. The person I just bought this manor, I have two things to insure. One, well, really three, right? I have my contents, my clothes and my pots and pans and things like that, my golf clubs, and my loss of use, right? Because if it burns, I'm going to need to go rent a place somewhere else. So that's part of that policy. That's on the property side. And on the liability, I have liability in the event I cause damage to the unit below me or the unit above me. So that liability, we recommend you buy a limit of $250,000 because that matches the self-insured retention or the shared deductible. So don't. Now, some of these insurance companies, like an Allstate or State Farm or Farmers, Nationwide, they'll say, "Hey, our HO6 policy is what it is. We don't just sell an HO6 contents only." Okay, the market is so difficult here. If that's the only option I have, well, then that's what I'm going to have to buy, right? But that doesn't mean that's what I need to buy, right? If you don't have that coverage, you don't really want that coverage because then you have a conflict of carriers, right? You've got the Nationwide adjuster talking to McLaren's, and so, but the Rossmoor policy covers everything inside that unit.
Everything attached in that unit, right?
Yeah, right.
Hello. I'm happy to hear that Rossmoor is winning and the premiums are down. But one thing I've been wondering about is whether additional mitigation in the forested areas could also improve the situation. I do appreciate the areas that are cleared around the buildings, but they only go up so far. And
I did an inspection this morning because now it's hot and the risk factor is up. And some areas there's 20 feet above the buildings, some 30, some 100 yards. There's some disking, and that's all good. I really appreciate the fact that Rossmoor does that. But I also have experience in the Sierras with some property me and my brothers own, and the rim fire, that massive fire, and what the Forest Service does now to mitigate. And if the Forest Service owned this property above our mitigation zones, it would be amazing what they would do. Yeah. They would cut branches, get the brush out, remove all the logs, the downed trees, and everything. So would it be possible if Rossmoor budgeted for more mitigation in the forests all around, especially in the west zone and the east zone? Could we then even do better, getting lower premiums or better coverage? So that's one of the thoughts I have.
Yeah, are you an insurance broker?
No what?
Because that is an excellent question. And so we got lucky last year, basically, right? Let's just say we had no hurricanes and we had very few wildfires, other than the Los Angeles fire, right? But the insurance industry had a couple of things going on during that very, very tough marketplace. They required everybody to increase their valuation, get appraisals, or just significantly increase your valuation. So you had to increase your valuation, right? Well, they charge premium on that. So you're getting whacked on that. And then you're getting hit just because of market conditions. So your valuation's going up 18%, and then your rate's going up 20%. So it was a double whammy. So then they have a very good year, and there's no wildfires, or limited wildfires and limited hurricanes, and so they go, oh well, we can make money. This syndicate is charging 48 cents for that capacity. I'll come in at 35. So you're seeing competition come in, and that's where people get comfortable at that point, right? Because rates are falling. But we got lucky. There's going to be more wildfires, and there's going to be more hurricanes, and it's now when really Rossmoor needs to keep their foot on the accelerator, right? This is what this slide just is talking about here. Managing aging infrastructure, it continued to continue to stay on top of it. That's what you're saying, is like, hey, maybe we should take some of this savings and allocate it towards greater wildfire protection. And that goes a little bit beyond my scope, because I can provide the information, and it's almost like, well, how much more can we save? It's not so much how much more can we save, but how much more can we limit in the event the market starts to turn and go up, right? So if everybody's going to get a 12% rate next year because there's been 3 hurricanes and 2 wildfires, right? Well, we don't want that 12, we want 2. Right? We want to stay, and that's another, from what your question, that excellent question about the alternative risk transfer, by having that buffer of $7.5 million, it takes the fluctuation out, right? Because those insurance companies that are on that, what we call the burn layer, you have to have a loss in excess of $7.5 million to get to them. So they're not going to be changing their rates as dramatically as if they were at, say, $1 million self-insured retention, right? So you've got, and along those same lines, you've got a lock-in rate on that $7.5 million for 5 years. So you've insulated yourself from an insurance perspective. The question is now, what you're asking is like, how do I get even better, right? And that's that's the goal.
You've heard of the California Fair Plan?
Yes.
Well, they charge a lot, but they're offering all their insureds a discount if they mitigate. And me and my brothers own a cabin, and we got the notice. So that's what part of why I was thinking mitigation equals discount.
Which is why we've got this 25%, right? In Firewise is when you have a giant community, it's not like looking at one homeowner, right? Firewise gives these underwriters a place to go, oh, I see what they've done as a community. Here's your discount. Here's your comp.
Ken, can I add a couple things?
Yeah, dive in, Zach.
Sure. So, yeah, as Ken mentioned, as far as on a kind of a discount basis, that Firewise, that bringing the carriers out to Rossmoor, letting them see the mitigation efforts, telling them every year how the mitigation efforts have improved, that has helped reduce the premium. That's a discount. It's not as, clearly stated as the Fair Plans discount, but it all goes into play. But another thing to consider on this mitigation, risk management, is the alternative risk transfer program, like Ken says, it provides a buffer. It creates it prevents losses really from hitting most of the carriers. Therefore, they are more comfortable with reducing rates, increasing limits, et cetera. But Rossmoor is now retaining $7.5 million. So mitigation becomes even more important because that if there is a big loss, the fund that is now over $10 million can get hit by up to $7.5 million. It can just be wiped out because it has to go pay that first $7.5 million of the loss. So that's why mitigation in all its forms, some of the things I mentioned about potential factors for the allocation, attic fire breaks, vents, electrical panels, all those things are very critical and very important for Rossmoor to keep improving, keep reducing the risk, because it reduces the chance that you will burn through all this money that you've saved.
Yep.
Hey, Zach, quick question. This is Michelle. When you're talking about allocation between the mutuals, what percentage do you use, or do you use any for wood frame?
So that is factored in. The wood frame is factored into what I was talking about, the ISO rate. So it's the occupancy, but also the wood frame. So the manors are all wood frame, where the clubhouses and stuff are usually a more durable material. So more fire resistant material. So that affects that kind of base rate that's applied to the values before we get into the adjustments.
So I have a question about, over here.
Yeah.
About incentives. We're incentivizing Rossmoor and we're incentivizing the mutuals, but are we incentivizing the manor owners? If I have a fire in my unit due to things that happen, I leave a pot on the stove, etc., I'm not sure that I am learning from my experience, whereas my neighbor is paying for my carelessness. Are we taking advantage of that in shaping our insurance so that the manor owner, where the fire originates, is bearing more of the cost?
As close as we get to that is in the mechanics of the shared deductible program, which is a Rossmoor contract. It's not an insurance industry contract, but the shared deductible program applies the first $10,000 to the of the loss to the mutual responsible, and then on top of that, then all the mutuals share up to the $250,000, and they come based upon the number of units that they have, and that mutual comes back in, and they have to participate again there. So the mutual is penalized. The individual manor owner is not penalized as to they made a mistake, something bad happened, and they need help. They need to have it fixed. So in terms of subrogation of a loss. In HOAs, it's very difficult to do. You could refer to Davis Sterling's, but basically everyone, all the manor owners are insureds, or let's take the bigger picture. In HOAs, all the unit owners are insureds. So you run into the fact you're suing yourself, right? That's why Davis Sterling makes it very clear about subrogation. That's a big discussion. And I don't think that there's any penalty for somebody that makes a mistake. I don't know if that's a good explanation, but it's the explanation I got. I'm sorry.
I have a two-part question. You've made clear what the walls in covers or doesn't cover, but you haven't said walls out. So I'm assuming, is it correct to assume that everything that happens outside our walls is covered by the policies that we have?
Yeah, excellent point. Thank you for bringing that up. So the kicker there is, remember, you have many insurance companies on this program, on this tower. So you can't have, again, I keep using these examples, but it's reality. You can't have Beasley issuing a policy, they're a London syndicate, and AIG issuing a policy, and Steadfast issuing a policy, and all the other ones, Canopius and Chubb and everybody else, issuing separate insurance policies, right? Because then you don't know, one of them might say, oh, I'm covering all the landscaping, and the other one might say, I'm not covering the landscaping, but I'm covering underground piping. So the way around that is we have a form, it's called the Gallagher Property Form. It's probably one of the most well-known and most utilized property forms in the world. It insures major cities, all the Catholic universities in the United States, and it's a very broad property form, and all the carriers sign on. Yeah, I'm following this one form. It's the lead policy, and everybody signs on to that. So that coverage form picks up everything at Rossmoor. The piping, the walls, everything that's exterior, all the landscaping. It's a very broad property.
So to clarify, a couple years ago, Rossmoor could not get insurance to cover 100% of the outside. That's what I wanted to ask.
Oh, yeah. So
what percent, so it used to be, what percent now is not covered of the outside of our walls?
Oh, in terms of limit of total insured value versus insured value. Zach, you got that exact number? It's somewhere, it's at 50, it's over 50%?
Yeah, the total insurable value is $2.8 billion. The total insurance limit purchased is now $1.5 billion. So you're over 50%. You're over that threshold of the 1 in $10,000 a year modeled loss. Okay. The thing is, once you try to go higher, there's no reason for insurance companies to do it because they can't make a profit off of it. Or if they do, then it would cost you too much money. So that's where you're kind of in this fine line about purchasing as much limit as possible, but not being able to get a full $2.8 billion or not being, either it's not available and or it is just not feasible to purchase. But remember, this is always per occurrence. So you would have to have a loss exceeding 1.5 billion. And this kind of goes back to the point someone else was making. It's very unlikely that you're going to have a loss that's $1.5 billion. But to the extent you do have a loss that's $1.5 billion, everything is on 100% covered. Okay, it's only when it exceeds that then you're not covered. So you would have to have if you have a $2.6 billion loss, right? Then you have $100 million that's not covered, right? And that's unlikely. Okay, yeah. Sorry, just one more thing on that is that
that more than covers it. Thank you. I have my second question relates to the way insurance companies make money, which you alluded to.
Yeah.
The majority of insurance companies invest in fossil fuels and in increasing the risk of wildfires. Do the insurance companies that you've listed, that in the sum total Rossmoor, or commits with, are they all investing in fossil fuels?
All the insurance companies that we do business with, I don't know the answer to that question. That's a good question. I mean, they're the biggest in the world. It's AIG, it's Zurich, it's Travelers, you're the biggest insurance companies in the world. So
those
I don't
all
know.
in our area, those all invest in fossil fuels.
I imagine they do, yeah. But I don't know how.
So they get us going and coming.
I'd like to go back to the shared deductible for just a quick question. I kind of understand how it works. Is that something that you require, or is that something that Rossmoor came up with as an internal policy?
That is, the insurance industry or Gallagher does not require that. That is a contract that was created a long time ago. I know Gallagher, because of the way it's drafted, I know we had probably a hand in doing it because we use it for other organizations that are similar. It's pretty simple. It doesn't get too confusing. There's not too many dials on it, right? And so we had a hand. John Taster probably assisted the CFO at that time and the risk manager at that time and gave him a playbook. But it's a Rossmoor contract.
My apologies, I had to come late, so this question may have been already asked and answered. I bought my unit 3 years ago, but only recently started living there, so I'm kind of behind the curve in understanding what's going on. I do know that the HOA fees went up exponentially because of the systemic issues that, in the insurance industry, fire risk, aging infrastructure. Are we at risk of that pace of HOA increases to continue?
The reason that took place, it was a global change in the property market. For probably the previous 15 years, property was the last thing discussed at any renewal. It's like, oh yeah, by the way, your property insurance went up 2%, right? It was, forget about it. Then all of a sudden, 2017, we saw wildfires and hurricanes, multiple hurricanes that did damage that we'd never seen before. And so all of a sudden, insurance companies they look at it and they go, oh, on this schedule, we had 4 buildings destroyed. There are 3 buildings destroyed. One's insured for $4 million, $6 million, and $8 million. Well, it's going to cost $22 million, $28 million, and $32 million to rebuild these things, right? So it drove valuations through the roof. It required everybody. So one part of my answer is Rossmoor has completed their appraisals. Valuations are up to speed, and we continue that. They'll probably take a year off and then start another 3-year cycle. So you're not going to see that doubled the amount of insurance that you need to buy. So you're not going to see that as well. Then we've put some things in place, right, where it's you've got that deductible. It was $250,000, which was kind of ridiculous for an organization this big. Right now, it's essentially $7.5 million. That alleviates some of the exposure. And then you've got this accordion at the top. But that top layer, you don't have to buy it, but really, it's not as expensive as the bottom. So it's a three-part answer. Your appraisals are up to speed, and your valuations are up to speed. Your deductible is dramatically higher than it was, and you got Firewise, which is making you a more attractive risk to underwriters, and you've got these strong relationships.
Thank you. And just one last question. What do you do to manage the aging infrastructure risks? You
Say that one more time. What do we do about it?
Yeah, how do you manage the aging infrastructure risks?
Well, one of the things that we asked the appraisal firm to do was kind of identify those locations as best they could with these electrical panels, which are a hazard, Zinsco, Federal Pacific, and that's just not here. It's across the United States. And so slowly mutuals are replacing those. So that's a significant issue. Attics, fire breaks in attics, some have them, some don't. I was in the unit that burned, and because it had an attic stop, it prevented several other units from being destroyed in that building. So that's a big thing. And just general upkeep of the roof for water damage. That's not limited to Rossmoor. It's every big property that I work with.
Thank you. My apologies, I have to leave for work, but thank you for answering my questions.
Thank you.
So each mutual is responsible for implementing defensible space and hardening. CAL FIRE and the Insurance Institute have offered extensive descriptions of what can be done. And is there anyone that a mutual can go to help prioritize the different things that can be done? You know, considering our limited funds, we want to direct it where it's going to be most effective.
Again, a solid question, and I see it all the time. I see it in my own community. I'm chairman of the fire commission in San Rafael, and San Rafael is always, dealing with the same issues. Hardening the landscape, getting homeowners to move bushes and things like that. So that's one of the reasons that we're adding Deborah Freeland to the Gallagher team, so that she can interact with the insurance task force to give best of class recommendations to the manors or to the mutuals. So that's going to be the role she's responsible for. And so that's we should be able to provide that information, and we do, but I just want to up our game.
Just as some hypotheticals, I just want to make sure I'm clear on this. If the loss at Rossmoor was, we'll just say $1.7 billion, the homeowners would each be assessed something for the other $200 million that wasn't covered?
If it's, I assume so. I mean, if we're getting hit with a $1.7 billion fire, I don't know if there's going to be anything left. I mean, that's a pretty dramatic deal. I don't know where to go on that one. That's a big loss, right?
That's a big loss.
Yeah, so it would be a special assessment, I'm sure.
Okay, so we want to thank you all for attending today. And somebody asked a really good question about how do we educate our neighbors. You can refer them to the Firewise website. We have a lot of good information about prevention, mitigation, and we also have a copy of the Firewise insurance certificate, which some companies are offering a discount, so you can send that in. I want to thank Ken and his colleagues for being here with us. And I want to thank all of you for braving the heat and coming to hear about insurance. So thanks very much.